Hello and welcome to today's video. If you've been following the Indian stock market recently, you might have noticed a sharp decline in major indices like the Sensex and Nifty. Many investors are panicking, but what's really behind this downturn? Today, I'll break down the reasons why the market is falling, the factors contributing to this slide, and what you should keep in mind as an investor. Let's get started. First, let's talk about foreign institutional investors, or FIIs. They are key players in the stock market, and when they pull out their money, it can cause significant volatility. Recently, FIIs have withdrawn over 20,000 crores from Indian equities. Why? Rising interest rates in the US have made American government bonds more attractive, pulling funds away from emerging markets like India. On top of that, geopolitical tensions, such as the Israel-Hamas conflict, have created uncertainty, making global investors hesitant. This heavy outflow of foreign money has been a major factor dragging the market down. Next, let's look at the global economic picture. Inflation in the US is still high, and the Federal Reserve has indicated that it might keep interest rates elevated for a longer time. This has created a ripple effect globally, as tighter monetary policies make borrowing more expensive and slow down economic growth. Crude oil prices have also been climbing, putting additional pressure on global inflation. All these factors reduce foreign capital inflow into India, leading to a slump in our markets. Now, let's focus on the domestic scene. High retail inflation in India has been a persistent issue, eroding consumer spending and investor confidence. Additionally, the valuations of Indian stocks, especially in the small and mid-cap segments, are at historically high levels. This has led to profit booking by both foreign and domestic investors. Moreover, sectors like real estate and manufacturing are struggling due to rising interest rates and sluggish demand. All of these contribute to weaker market sentiment. Certain sectors are feeling the heat more than others. For example, the IT sector, which relies heavily on exports, has been hit hard by the global demand slowdown. Similarly, the auto sector is grappling with high input costs, and banks are worried about rising non-performing assets due to higher interest rates. These sectoral challenges add to the overall market pressure, making it a difficult environment for investors. Political uncertainty also plays a big role. With the 2024 general elections approaching, investors are on edge. Historically, markets tend to react negatively to political uncertainty. If the current government retains power, there might be stability. However, if there's a change in leadership, markets could face short-term volatility as investors adjust to new policies. The upcoming state elections are also being closely watched as indicators of voter sentiment, adding another layer of uncertainty. So, what does the future look like? While the current correction might seem alarming, remember that markets are cyclical. Corrections like these often create opportunities to buy fundamentally strong stocks at lower prices. Investors should focus on diversification, consider systematic investment plans, and avoid overexposure to risky assets. Remember, patience and long-term thinking are key during volatile times. In conclusion, the stock market's decline is the result of a mix of global and domestic factors. While it's natural to feel concerned, this is a time to stay calm, do your and make informed decisions. If you found this breakdown helpful, don't forget to like, share, and subscribe for more insights. Thank you for watching, and I'll see you in the next video.